Okay, now section D. Following are the balance sheet and receipts and payments account of Golden Sports Club Bangalore. Balance sheet as on 31/3/2020. Outstanding salary. So whatever which appears in the opening balance sheet, you must be very careful with outstanding income, outstanding expenditure or income received in advance, because that will have an effect in the income and expenditure account. So outstanding salary 7,000. This is of 31/3/2020. That means you should have paid what actually in the current year, right? So then what you should do? You should delete it. So you should remember one important thing while converting receipts and payments into what actually income and expenditure. Income and expenditure will take into account only current year income and current year expenditure, that too revenue expenditure and revenue income. It will not take either capital or what actually the capital expenditure or capital income. So, and whatever in the balance sheet, previous opening balance sheet there, that adjustment how it should be taken, right? So I am going to teach you that in detail. Outstanding salary 7,000, keep it in mind. Pre-received subscription rupees 4,000. This is of next year. That means of that is 2021. You have received in 20 only. So you have to take into account for the next year. Capital fund 1,50,000 funded. I have told you that is in the what do you call non-profit organization. That is, they don't call it as capital, they'll call it as capital fund because it is the service that what they are providing. Cash in hand, sports material, furniture, land and building. Receipts and payments account for the year ending 31/3/2021. Now let us take the receipts and payments account. I will write here only how it should be, right? To balance brought down 15,500. It has already appeared in the opening balance sheet. Opening balance sheet. That means it will not be taken into account because it has already appeared. Subscription, it should be treated as revenue or, that means whenever I say or, that comes under what actually income and expenditure account. Entrance fees, wait, if nothing has been given, then you can call it as what actually receipt, that is revenue. If something is given, then we have to wait and see what adjustment has been given. Sale of old newspaper, always it will be sold, it is revenue. Sports fees, yes, it's a club, sports club, you have to collect often and often or. Then salary, you have to pay salary to the staff, it is or. Sports material purchase on 1/10/2020. It is an asset, it is called as capital. It is called as capital. That means it appears under closing balance sheet. Investment, investment is also capital. Whenever I say C, it is clear it should appear under closing balance sheet. Postage, often and often it is revenue. Electricity charges, it is revenue. Then upkeep of grounds. That means when you are doing a sports club, then you have to keep up your grounds often and often. For that you have to pay maintenance charges, which is called as revenue. Then closing balance carried down, which is called as cash in hand at the end on 31/3/2021, which appears under closing balance sheet. So this appears under opening balance sheet, has already appeared. This one appears under closing balance sheet. Now let us take one by one adjustment. Outstanding subscription for the year 1,000. Yes, you have to add that 1,000. Outstanding salary on 31/3/2021 5,000. Again it should be taken, it should be added for salary. Half of the entrance fees are to be capitalized. Here I have left what actually entrance fees. Here he says that half to be treated as revenue, half to be treated as capital. Then in such a case what you do is C plus R. That means half is revenue, half is capital. That means out of 6,000, 3,000 is revenue, 3,000 is capital. Next, depreciate sports material at 20% per annum. You must be very careful. Say opening balance sports material is there in the problem, that is 35,000. For this you have to calculate for 1 year, that is 20% of 35,000 is 7,000 for 1 year. Whereas you have purchased additional sports materials on 1/10/2020. 1/10/2020 means October, November, December, January, February, March. It comes to 6 months. For 6 months, you have to calculate 20%, that is for 18,000. So 20% of 18,000 is 3,600, that is for 1 year, but half year it becomes how much actually? 1,800. So that you have to keep it what actually in mind. Then depreciate expense at 20% per annum. Prepare income and expenditure account for the year ending 31/3/2021 and balance sheet as on that date. Right. So let us prepare now one by one, that is income and expenditure account for the year ending 31/3/2021. Expenditure, amount, income, right? I have written inner column, outer column. So you have to write, because adjustment will be there, then it will be written in the inner column. So let us start one by one. Here subscription 52,000. By subscription, by subscriptions, it is 52,000. 52,000. Then come back to the last year balance sheet. That is pre-received subscription is how much actually? 4,000. Pre-received subscription is 4,000. Now this 4,000 should be added to the current year, right? It has been received last year. And current year subscription received last year. Received last year. How much? 4,000. 4,000. Then likewise, outstanding subscription for the current year is how much actually? 1,000. And current year outstanding 1,000. Current year outstanding 1,000. Then you total it up, 57,000. So this is how you have to do, that is the adjustments, right? 57,000. Next item is entrance fees have to be capitalized. So by entrance fees, what you should do, that 50% of 6,000, half means 50%, 6,000 is 3,000. Then sale of old newspaper, by sale of old newspaper, it is sale of old newspaper is 3,000. Next, sports fees 9,500. By sports fees 9,500. Now we have finished what actually the income side. Now come to the expenditure side. Salary 25,000. To salary 25,000, inner column. Then come back to the opening balance sheet. Say you have that outstanding salary 7,000. That means what you have paid this year, that 7,000 belongs to last year. Then what I should do is, so less last year outstanding 7,000. Let it be inner column 18,000. Why? Here you have adjustment, outstanding salary as on 31/3/2021 5,000. That means add current year outstanding 5,000. Then write it in the outer column 23,000. So all adjustments should be done like this. Next, smart materials. Now it is no question after this. Capital, investment capital, postage 400. To postage 400. Then electricity charges 1,600. To electricity charges 1,600. Then upkeep of grounds 6,500. To upkeep of grounds, that is called as maintenance, right? That is 6,500. We have taken all adjustments here. Now we are supposed to take outstanding subscription, we have taken outstanding salary, we have taken half of the entrance fees, we have taken depreciate sport material at 20% per annum. I have told you on the opening balance 20%. For the additional, you have to calculate 20% for 6 months. So to depreciation on sports material A, 20% of 35,000, it is 7,000. Then B, 20% of 18,000 for 6 months. 6 months, not for 1 year, it is 6 months. It comes to 1,800. So total it comes to 8,800. 8,800. Just let us total it up and find out what is the surplus or we are going to get. 57,000 plus 3,000 plus 3,000 plus 9,500. 72,500. 72,500. So 72,500. Then let us say 23,000 plus 400 plus 1,600 plus 6,500 plus 8,800. 40,300 minus 72,500. Then it comes to 32,200. 32,200 is surplus. 32,200 is surplus, right? Now we have found out the surplus. Now what you have to do? You have to prepare now balance sheet. Now balance sheet, very simple. You take the first one, opening balance sheet. What is your capital fund? 1,50,500. Here you say that liabilities, then amount, then asset, then amount. Liabilities, it is capital fund. 1,50,500. 1,50,500, right? Plus entrance fees has been capitalized. Entrance fees 50% has been capitalized, that is 3,000, plus surplus, that is 32,200. Add it up. 1,50,500 plus 3,000 plus 32,200. 1,85,700. 1,85,700. Then you come to the thing, here nothing is there. Outstanding salary, one item is there. That is, here outstanding salary as on 31/3/21 is 5,000. Outstanding salary 5,000. Salary 5,000. Now liability side is over. Now let us come back to asset side. Asset side, cash in hand. Don't take this cash in hand. I have already shown you cash in hand. You are supposed to take the closing balance in the receipts and payments account. How much actually? 19,500. Cash in hand 19,500. Next, after that, sports material 35,000. Sports material, inner column 35,000 less depreciation, that is 7,000 minus, it comes to 28,000. Add additions, you have made additions of how much actually? 18,000. Add 18,000. Don't write it in the outer column, still you have to do depreciation for that. 46,000 less depreciation 1,800 minus, then write it in the outer column, that is 46,000 minus 1,800, 44,200. So sports material is over. Next, furniture, no change, it is 21,000. Furniture, no change, it is 21,000. Then land and building, no change. Land and building, no change, it is 90,000. Then you must be careful. Here you say that this has been taken, 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 this has been taken. Sports money has been investment. This is how much actually? 15,000 that you have purchased during the year. Investments 15,000. Now you total it up, it should tally. Now let us check. 1,85,700 plus 5,000, it comes to 1,90,700. 1,90,700. Then let us check on the asset side. 19,500 plus 44,200 plus 21,000 plus 90,000 plus 15,000. We are getting 1,000 rupees short. Don't worry. Outstanding subscription, how much? 1,000. Outstanding subscription 1,000. Say why I did it? Intentionally I did it because this is how you do in the examination. Don't worry, immediately go. This you got 1,18,700. Here you are getting 1,90,700. Don't become what you call scare. Something is gone. No, nothing worry. Just go to the adjustment. You might have taken one adjustment, but you have not taken the other adjustment. 1,000. If you add 1,000, then it becomes to 1,90,700. Students, what you can do is you can practice along with me. You take the book and what actually work out the problem like this. It becomes very easy for you. Now 30th problem. A and B are partners in a firm. Their balance sheet as on 31/3/2021 was as follows. Creditors 1,50,000, general reserve 50,000, capitals A and B 1,20,000, 80, cash at bank, stock, debtors, investment, furniture, building. On 1/4/2021, C is admitted into partnership on the following terms. He brings 60,000 as capital and 20,000 towards goodwill for 1/4 share in the future profits. Goodwill is to be withdrawn by the whole partners. Very simple. When you say that the goodwill that has been brought in by cash, then definitely it should be withdrawn because goodwill account cannot be shown in the balance sheet as per AS 26, right? That is accounting standards 26. Depreciate furniture by 10% and depreciate building by 22,000. Depreciate furniture by 10%. Appreciate building by 22,000 rupees. Now building is 1 lakh. Now at what actually 22, then it becomes 1,22,000. Investments are to be valued at 50,000. Investment is how much actually 40. Now valued at 50,000 means 10,000 increase. Provide rupees 2000 for outstanding salary. Prepare revaluation account, partners capital account and new balance sheet of the firm. So here you should observe, say A and B, how they were distributing the profit, it has not been given. It is very simple, they are equal partners. And where they have admitted C for how much share? 1/4 share. So it is very simple. First you should draw that one. What is revaluation account? Why you prepare revaluation account? Revaluation account is prepared to find out the revaluation of assets and liabilities, whether it has gained profit or it has incurred loss. That loss or profit should be transferred to old partners capital account only. Why? Because before admitting C, they would like to see that where the assets and liabilities stands as per the market. So that is why we prepare what actually revaluation account, right? That means the C will not take what actually he is not ready to take the balance sheet as it is. So he said that according to the system, you value whatever the profit or loss is there, that transfer to what actually old partners capital account, and old profit also, that is general reserve, undistributed profit, that should also be transferred to what actually old partners capital account. From date of 1/4/2021, whatever it happened, then it belongs to A, B and C, right? So first prepare revaluation account, revaluing the assets and liabilities. So revaluation account, particulars amount, debit side, credit side. So let us take one by one. Depreciate furniture by 10%. To furniture depreciate by 10%, 10% of 1,20,000, 10% of 1,20,000, it is 12,000. Then appreciate buildings by 22,000. Buy buildings 22,000. Then investments are to be revalued 50,000. Earlier it was 40, now it is 50, means 10,000 profit. By investments 10,000. Then provide rupees 2,000 for outstanding salary. So to outstanding salary 2,000. That's all. Then credit side is more than the debit side. Let us take, that is 32,000. Then 18,000, 14,000 goes off, then it is how much? 18,000. To profit transferred to old partners capital account. Capital accounts. A, that is 9,000, then B 9,000. So 18,000 goes to what actually now? 9,000 to A, 9,000 B. Now we have revalued the assets and liabilities, which is called as revaluation account. Now next they have asked what actually? Partners capital account. Let us prepare partners capital account. Partners capital account, particulars A, B and C, particulars A, B and C, debit side, credit side. By balance brought down, A 1,20,000, B 80,000. A 1,20,000, B 80,000. C dash by cash account dash he is going to bring 60,000. Then he is going to get what actually? 20,000 towards goodwill. So by goodwill, that is 10,000 dash. Now this has been withdrawn immediately, because as per AS 26, accounting standard 26, you cannot retain what actually? Goodwill, and you cannot show in the balance sheet. So to cash account, you can say goodwill withdrawn. That is 10,000 10,000 dash, right? Then here you have general reserve of 50,000. By general reserve 25,000 that is only to old partners. Then you have a profit on revaluation 9,000. By revaluation account 9,000 dash. Then find out how much it is. How much balance is there as per the capital accounts? 0, 0, 0. So 1,64,000, 1,24,000, and that is how much actually? 60,000. 1,64,000, 1,24,000, then 60,000. Then two balance carried down. 1,64,000 minus 10,000, it is 1,54,000. 1,24,000 minus 10 is 1,14,000. Then 60,000, it is 60,000. Right? So these are the balance which will appear in the balance sheet. Now we are supposed to prepare balance sheet. Right? So let us write balance sheet as on 31/3/2021. Capital accounts. A 1,54,000. B 1,14,000. C 60,000. 0, 0, 0, 8. So 3,28,000. Then we will take creditors 1,50,000. Creditors 1,50,000. 1,50,000. Creditors 1,50,000. Then you have outstanding salary rupees 2,000. Outstanding salary 2,000. Now asset side. That is very simple. Cash at bank. Now you open the bracket. You had an opening balance of 50,000 plus he brought 60,000 towards capital plus 20,000 towards goodwill, withdrawn rupees 20,000. So 50 plus 60 plus 20 minus 20, 20 goes off, then 50 plus 60 it comes to 1,10,000. 1,10,000. Then stock, no change, it is 50,000. Then investments, it is 40,000, it has been revalued plus appreciation 10,000, then it comes to 50,000. Next, furniture. Furniture 1,20,000 less depreciation 12,000. It comes to 1,08,000. 1,08,000. Then buildings 1 lakh. add appreciation. Add appreciation, that is 22,000. It comes to 1,22,000. You see how many items? 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. We have not taken one thing. Debtors, it is how much actually? 40,000. So we can say debtors 40,000. I did it intentionally again because this is how it happens in the examination hall. So that's why I showed you. You count, then the number of items must be like that only, so that you are not left any one item. Even in the previous problem also I have shown like that only. Here also, because you can learn along with me. You can learn along with me. Now let us total it. 3,28,000 plus 1,50,000 plus 2,000, 4,80,000, 1,10,000, 50,000, 50,000, 1,08,000, 1,22,000, then 40,000. So it is 4,80,000. 4,80,000. It is very simple. 4,80,000, 4,80,000. This is how you have to do. But you may have one small doubt that I will clarify you. Say the goodwill is distributed in the old ratio only, because old ratio and sacrifice ratio are one and the same. You work out, it becomes one and the same. You need not worry for that. So this goodwill, you can say that it has been distributed under sacrificing ratio. That becomes 1:1, and it has been withdrawn also. It is how much actually? 1:1. The same amount has been what actually now withdrawn, right? This is how you have to do admission of a partner. Now 31st problem. X, Y and Z were partners sharing profits and losses in the ratio of 2:2:1 respectively. Their balance sheet as on 31/3/2021 was as under. Balance sheet of as on 31/3/2021. Creditors, reserve fund, profit loss account, right? Capital X, Y, Z. Cash at bank, debtors 40,000 less PDD, provision for doubtful debt 2,000, outer column 38,000. Stock 20,000, furniture 10,000, machinery 20,000, building 50,000. Whenever debtors has been given like this, assuming that if I say that 20% create RBDD, then what you should do is 20% of 40,000 you should create. Then take out that 2,000 earlier, it has already been what actually created. The remaining only should be created. So you must be damn careful whenever, that is, provision for doubtful debt has already been or existed in the balance sheet. While calculating that, you must be doubly careful, because you are not supposed to calculate on 38,000, because it is only doubtful, it is not bad debt. So you cannot consider as bad debt, it should be only a doubtful debt, right? Then total of the balance sheet has been given 1,58,000, 1,58,000. Z retires on 1/4/2021 from the business. The following adjustments are to be made. Stock to be increased by 20%. How much stock is there? Stock is 20,000 is there. Now you have to increase it by how much actually? 20%. So 20% of 20,000 is 4,000. So it is 4,000 increase in stock. Then maintain RBDD, that is PDD, at 10% on debtors. So very simple. So 10% of 40,000 is 4,000. 4,000 means you have already maintained 2,000. So then you have to create only another 2,000. That means out of that is 4,000, 2,000 has been maintained. That means minus the 2,000. Then you have to take for evaluation account another only 2,000. Then depreciate machinery and furniture by 10% each. I hope you know how to calculate. Buildings are valued at rupees 60,000. The buildings are valued at 60,000 means buildings is how much actually? 50,000. So valued at 60,000 means 10,000 increase, right? Then Goodwill of the firm valued at rupees 15,000 as per AS 26. Again, as per AS 26 means you are not supposed to what actually show it in the balance sheet. It should be written off, right? Prepare revaluation account, partners capital account and balance sheet as on 1/4/2021. So first prepare revaluation account, particulars amount debit credit 2. So first we'll take stock to be maintained to be increased by 20%. By stock 20% of 20,000, it is 4,000. It is 4,000, right? Maintain RBDD, that is PDD, at 10% on debtors. 10% on debtors. So that is 2 PDD. 10% of 40,000 is 4,000. We have already maintained 2,000, minus it, then we have to maintain or we have to create only another 2,000. Then depreciate machinery and furniture by 10% each. Depreciate machinery and furniture by 10% each. Machinery 20,000 is there. To machinery 2,000. Then to furniture 1,000. Next, buildings are to be revalued at rupees 60,000. Building value is how much actually? 50,000. Revalued at how much actually? 60,000. That means 10,000 rupees is profit. So buy buildings 10,000. By building 10,000. I hope we have taken all items. Now find out profit or loss. I hope it is profit. It is 14,000 on the credit side. Put the same total on the debit side. 14,000 minus 5, it comes to 9,000. So profit is 9,000. To profit transferred to partners capital account. Partners capital account. So that is their partners are what type of, that is XYZ in the ratio of 2:1. So XYZ. So 9,000 into 2/5, 9,000 into 2/5, 9,000 into 1/5. So 9,000 divided by 5 into 2. 3,600, 1,800. Then it comes to 9,000. So revaluation account is over, right? Next is partners capital account. Partners capital account. Let us prepare partners capital account, right? So particulars XYZ. Then by balance brought down. Capitals of X is 50, 30 and 20. 50,000, 30,000, 20,000 capital. Then next, whatever the undistributed profit is there, first we will visit. Say you have reserve fund of how much actually? 20,000. That is just reserve, transfer that reserve 20,000 to partners capital account. By reserve fund, how much is their reserve fund? 20,000. So 20,000 should be divided in the ratio of 2:1. So 20,000 divided by 5, it is 4. That is 8,000, 4,000. If you don't understand, here I will write that is 20,000 divided in the ratio of 2:1. 2 plus 2 is 4, 4 plus 1 is 5. So 20,000 divided by 4 is, 5 is 4, 4 2s are 8, 4 2s are 8, 4 1s are 4,000, right? Then you have profit and loss account, how much actually? 2,500. By profit and loss account, how much it is? 2,500. Once again, it should be distributed in the 2:1, right? So it is 1,000, 1,500, 1,000, 1,000, then 500. Then you have revaluation profit, that is 3,600, 3,600 and 1,800. So by revaluation account, 3,600, 3,600, 1,800, 1,800. Then you must be very careful, you have goodwill, right? So you should be very careful with goodwill. Now goodwill of the firm is valued at 15,000. Now you are supposed to give only the share of retiring partner. Here I have left a few space here between revaluation account and partner's capital account to show you the goodwill calculation. Say goodwill of the firm is 15,000 into share of the retiring partner is 1/5. So it is how much actually? 3,000. It is how much actually? 3,000. 3,000. Now this 3,000 will be borne by whom? It will be borne by whom? It will be borne by X and Y. X and Y. So that is, the ratio is 2:1. Now if he goes out, then it becomes 2:2 or it is 1:1. Then what you should do is, this will be taken care of by X and Y, that is 1,500, 1,500, 1,500, 1,500, right? So for Z, X is going to contribute 1,500 and Y is going to contribute how much actually? 1,500. So then what I should write? By X capital account, within bracket you write goodwill, that is 1,500 for Z, nothing here, by Y's capital account, within bracket, what actually, once again, goodwill, that is dash 1,500, then it has been shared between X and Y, that is to Z's capital account, X has given 1,500, Y has given 1,500 dash. You see, credit is given 1,500, 1,500 and debit is given how much actually? 1,500, 1,700. So nullified, because as per AS 26, you are not supposed to what actually? Show goodwill in the balance sheet. So the total goodwill of 3,000 shared by X and Y, 1,500, 1,500. This is the adjustment you should see. The most important thing in the problem, I would like to teach you. Cash at bank is how much actually? 20,000, right? 20,000. Now you just see Z is the retiring partner. Roughly let me calculate how much is payable. 20,000 plus 4,000, 24, plus 500, 24,500, plus 1,500, 1,800, plus 1,500, say it is more than how much? 28,000 rupees. But you have a cash balance of how much? Only 20,000. Then what you should do? You should transfer that. That means you are not able to pay Z amount immediately. Then it will be transferred to what actually? Z's loan account. It will be transferred to what actually? Z's loan account. So what you should say? To Z's loan account. Here afterwards, he will not be a partner. He will become what actually a loan. That means he will become a creditor, right? Then to balance carried down. Then we have to find out what is the balance. What is the balance? $58,000, $59,000, $62,600, $62,600 minus 1,500, it comes to 61,100. Then 006 into number 42,600, 42,600 minus 1,500, 41,100. This is dash, this is dash, this is dash. Now whatever is there, 0, 0. So 29,300, 29,300. So loan account is 29,300. Here you see 29,300 we cannot pay because we have cash balance of how much? Only 20,000. Assuming you have 30,000 rupees cash balance, then you could have paid this 29,300 to cash account. No problem. When nothing has been mentioned in the problem, you must be doubly careful. You see the cash bank balance, then say that whether it should be transferred to loan account or cash can be paid, right? So now it is transferred to what actually? Loan account. Next, what they have asked? They have asked for balance sheet as on 1/4/2021. So we will prepare balance sheet. Now we have to prepare balance sheet of X and Y as on 1/4/2021, right? So it is very simple. Creditors 35,500, it as it is, there is no change. Creditors 35,500, no change. Then capital accounts X we have already calculated, that is 61,100, then Y is 41,100. So 61,100, then Y 41,100. So capital is 002, then 10, 1,02,200. Then Z's loan account 29,300. So we have finished what actually the liability side. Now let us write what actually the asset side. So cash at bank 20,000, no change. Cash at bank 20,000. Debtors inner column 40,000 less PDD 4,000, 2,000 plus 2,000, then it becomes 4,000. Outer column 36,000. Then stock 20,000 less, add appreciation 4,000, add appreciation 4,000, 24,000. Then machinery 20,000 less depreciation 2,000, outer column you write 18,000. Then furniture 10,000 less depreciation 1,000, outer column 9,000. Then buildings 50,000, add appreciation 10,000, outer column 60,000. Now the total is 1,67,000. This is how you have to work out the problem when retirement of a partner is given in the question paper. Now 32nd problem. Sridevi and Shripriya are partners sharing profits and losses in the ratio of 3:2. Their balance sheet as on 31/3/2021 is as follows. Sundry creditors 10,000, bills payable 10,000, Shripriya's loan 5,000, reserve fund 10,000. Capitals Sridevi 30,000, Shripriya 40,000. Cash at bank 5,000, bills payable 10,000, sundry debtors 20,000, stock 15,000, furniture 10,000, machinery 15,000, goodwill 30,000. Right? So it has been given very clearly. On the above date, the firm was dissolved. A. The assets were realized as follows. Bills receivable 7,500, sundry debtors and stock at 10% less than the book value, machinery realized 5% more than the book value, and goodwill realized rupees 12,000. Okay. Furniture was taken over by Sridevi, rupees 8,000. Dissolution expenses rupees how much actually? 600. All the liabilities were discharged in full. Prepare realization account, partners capital account and bank account. Right. So this is a very, very important concept. Right. Then how you should work out? So first let us just get you one simple example. Realization account you have to prepare, which is called as dissolution account. Realization account is called as dissolution account. Under dissolution account, you transfer all assets at book value to the debit side of realization account except cash and bank, and transfer all liabilities to the credit side of realization account except partner's loan. You must be damn careful with that, because partner's loan either it should be transferred to partner's capital account or it should be paid off directly. Say we have only two choice, not the third choice. That cannot be transferred to what actually is the realization account, because it belongs to partner. If it cannot be paid, then it will be transferred to partner's capital. Ultimately, partner's capital account will also be not paid, right? So this is the first step. Then whatever the amount realized out of the assets, then that should be taken on credit side of the realization account. Whatever the amount paid to the liabilities, it should be taken on the debit side of realization account, and we should find out whether it is profit or loss on account of realization, right? So first let us transfer all assets to the debit side of realization account at book value. This is debit side 2, this is credit side by. Now transfer every item except cash and bank. To bills receivable 10,000. To bills receivable 10,000. To sundry debtors 20,000. To sundry debtors 20,000. To stock 15,000. Stock 15,000. To furniture 10,000. To furniture 10,000. Then to machinery 15,000. 15,000. To goodwill 30,000. 30,000. So it is 1 lakh. It is better to work out like this. Don't write it straight away outer column. Then because it becomes very easy to find out whether it is profit or loss. So total asset value is how much? 1 lakh. Now transfer all liabilities to the credit side of realization account. Sundry creditors. By sundry creditors 10,000 inner column. Bills payable 10,000. By bills payable 10,000. Total 20,000. Don't transfer Sri Priya's loan. Right? Next. Now you take all the assets realized on the credit side of realization account. That is, all assets realized on the credit side of realization account. By bank account, you write one by one. Bills receivable realized how much? 7,500. Bills receivable 7,500. Sundry debtors and stock at 10% less than the book value. Stock and sundry debtors 10% less than the book value. That is sundry debtors that is 20,000 minus 10%. It is 18,000. Then stock it is 15,000 minus 10%. It comes to 13,500. You need not write in the examination like this, just you should understand, that's why I am writing like this, right? 13,500. Then machinery realized 5% more than the book value. Machinery is 15,000. Machinery, that is 15,000 plus 10%. Instead of minus, now it is 10%. So then it comes to how much? 5% or 10%? It is, 5%. It is not 10%, it is 5%. So 5%. 5% of 15,000 is 750. Then it comes to 15,750. 15,750. Then goodwill realized rupees 12,000. Goodwill realized rupees 12,000. Now the total assets realized is how much? 66,750. You see how much is the value of the assets? 1 lakh. It realized how much? 66,750. That means we have not gained profit, we have incurred loss, right? That is one point. Next point. Furniture was taken over by Sridevi at rupees how much? 8,000. So by Sridevi's capital account, that is furniture taken over. It is 8,000. Even if you include 8,000, 66 plus 8, it becomes 74,000. Value is 1 lakh. 1 lakh minus 74 means it is loss. We have incurred a loss of another 26,000 and odd, right? That is 8,000 loss. That is 8,000, it is there. Next, dissolution expenses 6,000. All liabilities were discharged in full. So to bank account There are two liabilities. One is creditors 10,000, the other one is bills payable is how much actually 10,000. So creditors 10,000, bills payable 10,000, outer column 20,000, no profit, no loss. To bank account again, to bank account, realization expenses, realization expenses rupees 600, that should be paid through bank. So 600, right? Then it is 100% loss. Then we have to find out that loss. 1,20,600, 1,20,600. Now loss is 25,850. By loss transferred to partners capital account. For the partners is Sridevi and Shripriya. Sridevi within bracket 25,850 into 3 by 5. Shripriya 25,850 into 2 by 5. Into 2 by 5. It is 15,510. 510. Then 10,340. So this is the loss on account of realization, that is dissolution. So 15,510, 10,340. Now we have to prepare partners capital account. Now partners capital account, particular Sridevi Shripriya, particular Sridevi Shripriya. This is debit side, this is credit side, this is to, this is by. So by balance brought down 30,000, 40,000. By balance brought down 30,000, 40,000. 30,000, 40,000. Now you have a reserve fund of how much actually? 10,000. By reserve fund 10,000 should be divided in the ratio of 3:2. That is 6,000, then 4,000. Then you have incurred a realization loss. How much? 15,510, 10,340. I hope you can see 15,510 and 10,340. So to realization account within bracket you say it is loss 15,510, 10,340. 10,340. Then loss has been taken over. Then Sridevi has taken over furniture. Sridevi has taken furniture for rupees how much actually? 8,000. To realization account. Furniture taken over. Who took it actually? That is Sridevi took it. That is 8,000. 8,000 Sridevi took it. Not Shripriya, Sridevi took it. 8,000. Right? Then whatever is there, that will be paid through bank. To bank account, we should find out how much we have to pay for them. Now the amount payable to Sridevi is 12,490 and to Shripriya is 33,660. Finally, we have to do bank account, right? So let us prepare bank account. Now we have to prepare bank account. So here bank account is there. particulars, that is amount debit, credit 2. You have a cash balance of how much actually? 5,000. To balance brought down. How much? 5,000. To realization account. Assets realized. I hope now you have understood why I have written everything in the inner column. It is how much actually? 66,750. Straight away I can write now 66,750. If you write separately, then you will have to add now again. It is better first you write it like that only. Now debit side is over. Now credit side. In credit side, that by realization account, that is liabilities paid off. That also it is very simple. I will show you. Bank account, how much actually? 20,000. So straight away you write 20,000, right? Then again by realization account, that is dissolution expenses or realization expenses, that is 600. Here it is there, dissolution expenses is 600. Then you have a Supriya's loan of rupees how much actually? 5,000. I told you this can be treated in two ways. One is it can be transferred to partner's capital account, that is Supriya's capital account. Then you can pay through capital account, or straight away you can pay what actually in the bank account. It is one and the same. So by Supriya's loan account, that is 5,000. Supriya's loan account 5,000. Then you have to pay only the partner's capital balance, whatever it is remaining. 12,490, then 33,660. That you have to pay. Now by Sridevi's capital account, 12,490 by the other one is Sripriya's capital account, it is 33,660. So 33,660, if I am right, forgotten, that is 33,660. If you total it up, it should tally. Now you see the total is 71,750. It is tallied. That means the problem what you have done, it is 100% right. So this is how you have to prepare the, in case of dissolution, realization account, bank account and partners capital account. Now 33rd question. Hema Company Limited issued 10,000 equity shares of ₹100 each at a premium of ₹5 per share. The amount was payable as follows. Students, I have written this one in the next page, top only, because often and often instead of turning the page. What I read, I have written here only. Hema Company Limited, 5 rupees per share. The amount payable as follows. ₹10 on application, ₹50 on allotment including premium. That means 50, 5 rupees is premium. So 50 minus 5 is 45. So 45 is allotment, 5 rupees is share premium. Then 45 first and final call. So 45 plus 45 is 90, 90 plus 10 is 100. All the shares were subscribed and the money duly received except the first and final call on 500 shares. That is, on first and final call, 500 shares did not pay the amount. The directors forfeit. So what is forfeit? Forfeit two things. One is whatever the amount which has been given by them is also forfeit, and they are going to forfeit the allotted number of shares also. That is called as cancel. Cancel two things, the amount given and the number of shares is both is called as what actually forfeiture. And reissued at rupees 80 each fully paid. Pass the necessary journal entries. So it is very simple. So let us pass these journal entries one by one. So the first one is 10 rupees on application. Journal entries in the books of Hema Company Limited. Date, particulars, ledger folio, debit, credit. No question of date here. You can say number, that is journal entry number. You can write 1, 2, 3 like that, because date has not been given. So bank account debtor, 10,000 into 10 rupees. It comes to 1 lakh. It comes to 1 lakh. 2. Share application account. Share application account 1 lakh. Application money received on 10,000 shares. Application money received on 10,000 shares. That is narration. Brief history of the transaction. Next, application money should be transferred to capital. So share application account debtor. Share application account debtor 1 lakh to equity share capital account. Equity share capital account 1 lakh. 1 lakh. Application money transferred to share capital account. Share capital account. So narration is over. Next, the third journal entry. The third journal entry says what actually? 50 rupees on allotment including premium. Premium is how much actually? 5 rupees, right? So 5 rupees is premium, means 45 plus 5, it becomes 50. So third journal entry. Share allotment account debtor. Share allotment account debtor, that is 10,000 into 50. 50, it is 5 lakh. 5 lakh. To equity share capital account. Equity share capital account, that is 10,000 into 45. 45, it is 4,50,000. To security premium account. Security premium account, that is 10,000 into 5. It is 50,000. So allotment money due along with premium. So that is the narration. Along with premium. Now you have received that one also. The fourth journal entry, that is bank account debtor. Bank account debtor, that is 5 lakh. 5 lakh. To share allotment account. Share allotment account. How much? 5 lakh. That means allotment money allotment money duly received. Allotment money duly received. Finish. Next, fifth journal entry. That is 45 on first and final call, right? Now, first and final call money. First and final call money for 10,000 shares, it is 45 rupees. So, share first and final call account debtor, that is 10,000 into 45. It is 4,50,000. 2. Equity share capital account. Equity share capital account 4,50,000. Share first and final call money due on 10,000 shares. 10,000 shares. It is due. Now, sixth one. You have not received the whole 10,000 shares, where you were not able to receive on 500 shares. That means out of 10,000, 500 minus means you have received only for 9,500. So, bank account debtor, that is 9,500 into 45. It comes to 4,27,500. To share first and final call account 4,27,500. 500 you did not receive. So 500 into 500 you could not get it, right? So that is very, very important. So you just check that one, that is 9,500 into 45. You will get 4,27,500, right? So share first and final call money received only on 9,500 shares. 9,500 shares. Now, the directors forfeited these shares and reissued at rupees 80 each, fully paid. So first we have to write forfeiture. So when you are forfeit, then instead of crediting capital, now you debit capital. Equity share capital account debtor. One second, I will tell you the number of entry. That is 7th journal entry. Equity share capital account debtor, that is 500 into 100, right? 500 into 100. It comes to how much actually? 5 lakh. 5 lakh. 2. Forfeited shares account. Forfeited shares account, that is they have paid 500 into 55, they have paid. 500 into 55 they paid, that is 27,500. To share first and final call account, that is 500 into 45 they did not pay. So it is how much actually? 22,500. So what you have to do? It is non-payment on 500 shares has been forfeited. Has been forfeited. Now what they have done? Now they have done, that means they have reissued at rupees how much actually? 80 per share. So now they have reissued bank account debtor, that is 500 into 80. 500 into 80, it comes to 40,000. Forfeited shares account debtor, that is 500 into, that is 20, it comes to 10,000. 2. Equity share capital account, it is 50,000. Forfeited shares were reissued at rupees 80 per share as fully paid. But you have to pass one more journal entry. What is that? Whatever the balance is there in forfeited shares account, that should be transferred to capital reserve. Why it is capital reserve? You are going to earn that capital reserve only once in a way. I have already told you what is forfeiture. Forfeiture, don't think you are forfeiting only shares. You are forfeiting shares as well as the amount which has been given up to allotment, right? But that allotment includes what actually premium amount also. Then how to adjust? That is forfeited shares account debtor to capital reserve account, right? Now the last journal entry, forfeited shares account debtor 15,000 to capital reserve account. 15,000. Now balance in forfeited shares account transfer to capital reserve account. You might be surprised. 27,500, right, minus 10,000, 27,500 minus 15,000 means it should have been how much actually? 10,000 minus, it should have been 17,500. But I have written only 15,000. So you must be very careful. This 27,500 includes a premium of 2,500. So that premium cannot be taken into account. Premium has already gone to what actually? Premium. So what you should do is you minus that 2,500, then it becomes how much actually? 25,000. 25,000 minus 10,000, it is how much actually? 15,000. So you can say like this, say it is a note that I am going to get you for you to understand, right? Forfeited shares, it is 27,500 minus premium 2,500. How it is? That is 500 into 5. It is 2,500 Then it comes how much actually? 25,000. You should not supposed to take 22,500. 25,000 minus that 10,000 which is debited. That means loss we have incurred. Loss on reissue. Loss on reissue. So the balance is how much actually? 15,000. This 15,000 has been transferred to capital reserve account. Capital reserve account. So that it is clear why it has been done like that. Correct? This is how we have to do the problem in issue of shares. Now 34th problem. Pass the journal entries for the following. Issue of rupees 50,000. Students, you must be very careful. Rupees 50,000, 8% debentures rupees 100 each. That means they are issuing only 500 debentures of rupees 100 each. Then it comes to how much actually? 50,000. It is not say debentures, it is rupees. 8% debentures 100 each at a discount of 10%. So 10% discount means that is called as out of 50,000. If you take 10%, then it becomes 5,000. Then it is 45,000 of 10% and redeemable at par. Issued at discount but redeemable at par. Again issue of rupees 50,000, 8% debentures of rupees 100 each. Again rupees 50,000 at a premium of 10% and redeemable at par. Issued at discount, redeemable at par. Issued at premium, redeemable at par. Issue of 50,000 rupees, 8% debenture of 100 each at a premium of 10% and redeemable at a premium of 10%. So issued also at premium and redeemable also at premium. Issue of 50,000, 8% debentures of 100 each at a discount of 10% and redeemable at a premium of 10%. Say here you have issued at discount but you are redeeming at premium. Then how to pass journal entries? So let us start one by one. So in each one you have two entries. First one A, or you can say A first one. I can say like that because A, B, C has been given. A the first journal entry, that is bank account debtor. Bank account debtor, that is, it is very simple, 50,000 minus 10%. Then it comes to how much actually? 45,000. To debenture application and allotment account 45,000. That means debenture application money received. Debenture application and allotment money received. Fine. Received. Now you are going to redeem that one at what actually? Par. At par. Now what is the journal entry? Second journal entry. The second journal entry, transaction A, it is debenture application and allotment account debtor 45,000. Discount on issue of debentures account, that is 5,000 to 8% debentures account, to 8% debentures account. It is 50,000. Debenture application money transfer to debentures account. Debentures account. Debentures account. The next, issue of 50,000 8% debentures 100 each at a premium of 10% and redeemable at par. So B, first transaction, bank account debtor, that is 50,000 plus 10%, it comes to 55,000. To debenture application and allotment account 55,000. Debenture application money received. In all transactions, narration is one and the same. Then second one, debenture application and allotment account debtor 55,000 to 8% debentures account. To 8% debentures account 50,000 to securities premium account 5,000. Securities premium account 5,000. Debenture application money transfer to debentures account. So B is over. Now next C, issue of 50,000 8% debentures of rupees 100 each at a premium of 10% and redeemable at a premium of 10%. Right? So C, under that, first one, that is bank account debtor. Again it is 50,000 plus 10% premium, it comes to 55,000. Right? To debenture application and allotment account 55,000. Debenture application money received. Now second one, debenture application and allotment account debtor 55,000. Loss on issue of debentures, loss on issue of debentures account debtor 5,000 to 8% debentures account 50,000 to premium on redemption account, redemption on debentures account 5,000 to security premium account 5,000 debenture application money transferred to debentures account Now D, issue of 50,000 8% debentures of ₹100 each at a discount of 10% and redeemable at a premium of 10%. Now bank account debtor that is 50,000 minus 10%, it is 45,000 to debenture application and allotment account 45,000 of debenture application money received, Then second one, debenture application and allotment account debtor 45,000, loss on issue of debentures account debtor, you write discount rupees 5,000 plus 5,000 premium on redemption, double loss 5,000 plus 5,000, then it comes to 10,000 to 8% debentures account 50,000 to premium on redemption of debentures account 5,000. Same narration, debenture application money transferred transferred to debentures account. Debentures account. Students, you must be damn careful while writing the second journal entry in each transaction. Why? Because how it has been issued and how it has been what actually redeeming, that is very very important. So just let me explain you. In this case, if you take the case, issue of 50,000 8% debenture is 100 each at a discount of 10%. Yes, 10% discount we have taken 45. But unredeemable at a premium of 10%. We have incurred a loss of 5,000 here, and here we are giving what actually 10% premium. 50,000 5% premium, 10% premium is another 5,000. 5,000 we have incurred loss. Again we are incurring a loss of 5,000. Total loss comes to how much actually? 10,000. That is 45,000 loss on issue of debentures account, 5,000 plus 5,000. 5,000 on issue, 5,000 on redeemable, we have to pay another 5,000. So total it comes to 10,000. So 8% debenture is how much actually? 50,000. So premium redemption of debenture is how much actually? 5,000. So these are the things that you have to keep in mind before passing the journal entries. If you pass all these 8 journal entries, you will get, that is 12 out of 12. Now 35th question. From the following balance sheet of Karnataka Company Limited, prepare common size balance sheet. What is common size balance sheet? Reduce the all items to, that is maximum 100%. Right? That is common size. Why it should be? It is one of the financial statement. Comparison becomes very easy. Right? Instead of, say, I'll get you one simple example. Say 5 lakh, 8 lakhs, it is 3 lakhs. If I say 50 lakh 82,932 versus 32 lakh 38,933, it is a tough job. Instead of that, if I say that in percentage, 74%, 64%, 32%, 30%, 31%, 38%, I think it becomes very easy. Comparison becomes very easy. For that sake, we prepare common size balance sheet, right? So they have asked to prepare common size balance sheet as on 31/3/2020 and 31/3/2021. Balance sheet as on, it has been given equity, shareholder equity and share liabilities, shareholders fund, share capital, reserves and surplus, then non-current liabilities, that is long-term borrowings, then current liabilities, short-term borrowings, assets, non-current assets, then tangible assets, intangible assets, current assets, inventories and other current assets. So what you have to do? Very simple. Now if I take shareholders fund 8,50,000, out of 15,50,000, it is 8,50,000, means for 100 it is how much? I hope you have converted, that is such things right from your 6th standard or 7th standard. First we do the calculation, that is 1 lakh divided by 15,50,000, what is the percentage? 4,50,000 divided by 15,50,000, what is the percentage? 1,50,000 divided by 15,50,000, what is the percentage? So first we will calculate all the percentages for both the years, that is for 31/3/2020 and 31/3/2021. Once you calculate the percentage, now you have everything on hand, then you prepare common size what actually balance sheet. For your level, they have asked only to prepare common size balance sheet. But when you go for higher level, when you prepare the common size balance sheet, then you are supposed to analyze, you have to comment, right? Then you say that what it indicates, how it indicates, right? Now at this step, there is no need that you just do what actually the common size balance sheet. But first we will do what actually the calculation part. So first item, it is share capital. So I will show you how to do it. Share capital, how much? 8,50,000, 8,50,000 divided by, what is the total? 15,50,000, 15,50,000 into 100. We will find out how much it is, right? Then 10 lakh, 10 lakh divided by 18 lakh 50,000 into 100. Then we will find out how much it is. So if you take the calculator, it very simple way of I will show you how to do it. You say 8,50,000 divided by 15,50,000 15,50,000 press only percentage button. Then you will get how much actually? 54.83 54.83%. 54.83%, right? Then likewise here you will say 10 lakh divided by 18 lakh 50,000 percentage. It comes to 50.05%. 54.05%. Now you just see, it was 54.83%, now it has come to 54.05%. See, this is how the things will go, right? Now, in the similar fashion, then we will do for what actually? The second one, that is called as reserves and surplus. Reserves and surplus. Reserves and surplus. How much it is? 1 lakh divided by 15 lakh 50,000 into 100. Find out how much. Then likewise, it is 50,000 divided by 18 lakh 50,000 into 100. So take the calculator, take 1 lakh divided by 15 lakh 50,000. Just press the button. Then it comes to how much actually? 6.45%. 6.45%. Likewise, you do it for the other one, that is 50,000 divided by 18 lakh 50,000. 18 lakh 50,000. Press the button. It comes to 2.70%. 2.70%. Students, I hope you understood. That is 6.45, 62 points. That means reserves and surplus has what actually reduced. Here, share capital has also reduced, right? So, if you do it for all the items like this, So, first I will write one by one all the items like that, right? Then I will calculate straight away. That is long-term borrowings. Long-term borrowings. It is 4,50,000 divided by 15,50,000 into 100. We will calculate afterwards. Then likewise 5,75,000 divided by 18,50,000 into 100. Then fourth one, that is short-term borrowings. The next one is short-term borrowings. Short-term borrowings. It is 1,50,000 divided by 15,50,000 into 100 percentage. Then 2,25,000 divided by 18,50,000 into 100. So these are the items of liability side. Just we will calculate in 2 minutes these two items. I have written everything. So short term 1,50,000 divided by 15,50,000 into 100, 9.68, 2,25,000 divided by 8,50,000 into 100 for everything. 7,50,000 divided by 15 lakhs into 100 is 48.39, 48.39%. Then likewise 9 lakh divided by 18,50,000 is 48.65. You can calculate in your calculator. Then 4 lakh divided by 15,50,000 is equal to 25.81. 25.81. Then 4,50,000 divided by 18,50,000 is 24.32. 24.32. Then 1 lakh divided by 15,50,000 into 100 is 6.45%. Then 2 lakh divided by 18,50,000 is, that is 10.81%. Then 3 lakh divided by 15,50,000 is 19.35%. 19.35%. Then 3 lakh divided by 18,50,000 into 100 is 16.22%. So this is the first step. When you do this, then you have to write only common size balance sheet. Everything is ready. Only one thing is, now fast forward, just copy it what actually in your common size balance sheet. Now common size balance sheet as at 31/3/2020 and 31/3/2021. Particulars, then absolute amount which has been given in the problem, then percentage of each in each to the total assets. So that what we have already calculated, right? So we are going to write that percentage. Now let us write one by one. First is what actually equity and liabilities. You need not worry for that. Here it is there, equity and liabilities. The same heading that I am writing here. Equity and liabilities. Liabilities. Under that, shareholders fund. Shareholders fund. Shareholders fund. A, share capital. Share capital 8,50,000, then 10 lakh. Percentage we have already calculated, it is 54.84 and 54.05. 54.05. B, reserves and surplus. Reserves and surplus, it is 1 lakh, then 50,000. While working out, you just keep the question paper along with you so that it becomes easy for you. Then it is 6.45%, then 2.70%. Right. Next item, second item in the liability side, non-current liabilities. Non-current liabilities. Non-current liabilities. Under that, long-term borrowings. Long-term borrowings. Everything I am writing as per what actually your question paper. 4,50,000. 4,50,000. Then 5,75,000. 5,75,000. It is 29.03%. Then 31.08%. Right? Then third item, current liabilities. Current liabilities. Under that, short-term borrowings. Short-term borrowings. 1,50,000. Then 2,25,000. 2,25,000. It is 9.68%. Then 12.16. Right? So total, very simple, total. Then we will write it afterwards, total, don't worry. Then second one, this is first one. This is first. Now this is second. That is assets. Under assets, number one, non-current assets. Non-current assets. A. Fixed assets. Under fixed assets, you have two types of assets. One is tangible assets. That is 7,50,000. Then 9 lakh. 7,50,000 and 9 lakh. Then it comes to 48.39%. Then 48.65%. Second one, intangible assets. That is 4,50,000. It is 25.81%. Then 24.32%. Then second one, current assets. A. Inventories. It is 1 lakh. Then 2 lakh. 1 lakh, 2 lakh. Percentage is 6.45%. Then 10.81%. B. Other current assets. 3 lakh. Then it comes to 19.35%. Then 16.22%. Then total. So first total is, as per the balance sheet only, it is 15,50,000. then 18 lakh 50,000. Then this must be equal to 100%. Anything 1 or 2% like this, you just adjust, readjust, no problem, because recurring numbers will be there that you may get little bit difference of 0.01 or 0.02 like that. You need not worry, you can adjust that one, that we'll see that one. Then total of the second one is 15 lakh 50,000, 50,000, again 18 lakh 50,000, then again it is 100%, 100%. You will get 100, only here earlier I had 12.16, you make it as 12.17, only 0.01, then both it becomes 100. That means you have reduced the whole balance sheet into 100. That is called as common size. That means both the years it has been reduced to 100. You do not have to write comment, so for that sake you need not worry. So just you see that, I will just repeat, I will show you, right? So first what you have to do, you have to prepare these transactions, right? This is very important, right? You calculate for all the items, right? Then you prepare what actually the common size balance sheet, common size balance sheet. It becomes damn easy. Then this particular absolute amount has been given in the balance sheet. We have calculated earlier, that we have written, that must be equal to 100%. Now 36 problem. From the following information, calculate inventory turnover ratio, that is stock turnover ratio, trade receivable turnover ratio, that is called as debtors turnover ratio, trade payable turnover ratio, which is called as creditors turnover ratio, earnings per share, which is called as EPS, book value per share, dividend payout ratio. You have to calculate with little bit careful with dividend payout ratio, because you have to do two calculations. I will tell you how you should do that two calculations, right? So first, inventory turnover ratio. For that they have given all the informations. Inventory is 1 lakh, 70,000 equity shares with 10 is 7 lakh, cost of revenue from operation, which is called as what actually the sales, it is 5 lakh, net purchases 4 lakh, net profit before tax it is 3 lakh 50,000, 13% debentures is 3 lakh, net profit after tax but before dividend, net profit after tax but before dividend 1 lakh 75,000, trade receivables 50,000, trade payable 75,000, dividend declared at 15%. So this you must be very careful how you are going to work out this problem. So first let us start what actually the first one what they have asked is inventory turnover ratio. So first one, inventory turnover ratio. Within the bracket I will write, which is also called as stock turnover ratio. It is one and the same, STR, right, is equal to cost of revenue from operations divided by average inventory. What is cost of revenue? That is called as sales. Sales divided by average inventory. Average inventory means opening stock plus closing stock divided by 2 is called as average inventory. But in the problem, they have given cost of revenue is 5 lakh. They have given only what actually the trade receivable, trade payables and net purchases, right? That they have given. They have not given what actually only inventory has been given. They have not given opening stock and closing stock. That means inventory itself is called as what actually average. We will assume this is called as what actually average. Then it is how much actually revenue from the operation is 5 lakh divided by it is 1 lakh average assumed. It is called as assumed. That means it is average. So it comes to how much actually? 5 times. In all concepts, you are supposed to take average debtors. You are supposed to take average creditors. When nothing has been given, assume that when only one item has been given, it is implied that it is average. It is called as what actually? Average. Right? Second one. What is the second question they have asked? The second question is trade receivables turnover ratio. Trade receivables turnover ratio, which is called as debtors turnover ratio. Debtors turnover ratio is equal to net credit revenue from operations divided by average trade receivables. So I have told you everything is assumed because average they have given only one trade receivable. So net credit, what actually they have given only one, it is how much actually? 5 lakh divided by average trade receivables is how much actually? 50. So net credit revenue from operations divided by average trade receivables. I told you always they have given only one, which is called as trade receivables has been given, it is 50,000. So 5 lakh divided by 50,000 is equal to 10 times. 10 times. So I have already done 2 ratios now. Now the third ratio. What they have asked the third ratio? The third ratio is trade payable turnover ratio. So the third one is trade payable turnover ratio. Trade payable turnover ratio. It is also called as creditors turnover ratio. Creditors turnover ratio. The same thing, but here it is what you have to write, what actually the net credit purchases. Net credit purchases divided by average trade payable. Average trade payable. I told you average, but here everything has become only one. So what you should do? So net credit purchases is how much actually? 4 lakh. 4 lakh divided by average trade payable. Average trade payable is how much actually? 75,000. So 75,000. Then find out it is how much? That is 4 lakh divided by 75,000. It comes to 5.33 times. 5.33 times. So we have done the third ratios. How many ratios they have asked? They have asked 5. We have already done 3. So earning per share. Next one is earning per share. Earnings per share, which is popularly known as EPS. Popularly known as EPS, right? EPS is equal to profit available for equity shareholders. Equity shareholders divided by number of equity shares. Number of equity shares. Now, profit available for equity shareholders has been given in the problem. Very clear, it has been given in the problem. Net profit after tax but before dividend is how much actually? 1,75,000. 1,75,000 divided by number of equity shares. It has been given in the problem, it is 70,000. So 70,000. So 1,75,000 divided by 70,000, it is 2.5. So EPS is 2 rupees 50 paisa. That is 2 rupees 50 paisa is EPS. Next, book value per share. Fifth question, book value per share. That means what is the value of the share as per the book value. So then what you have to do is equity shareholders fund. That is book value per share is equal to equity shareholders fund divided by number of equity shares. So now equity shareholders fund is equal to equity share capital, that is 7 lakh, plus net profit 1,75,000. Then it comes to how much actually? 8,75,000. So equity shareholders fund is how much actually? 8,75,000. Now apply 8,75,000 divided by 70,000. So is equal to 12.5 per share. 12.5 per share. This is as per book value. As per book value, it is 12 rupees 50 paisa. You can write like this, 12 rupees 50 paisa per share. 12 rupees 50 paisa per share. Dividend payout ratio. Last one is dividend payout ratio. Dividend payout ratio is equal to dividend per share divided by earnings per share. Now dividend per share, you have to calculate dividend per share. Now they have given in the problem, dividend declared is how much actually? 15%. 15% on how much? That is 7 lakh, right? So now you write 15% of rupees 7 lakh. 15% of 7 lakh, that is 7 lakh into 15 divided by 100 is equal to 1,05,000. Let me just check it is right or wrong. 7 lakh into 15 percentage, it is 1,05,000. So 15% of 7 lakh, 1,05,000. Number of shares is how much? Number of equity shares is how much? 70,000. Then dividend per share is equal to that is 1,05,000 divided by 70,000 shares. So it is 1 rupee 50 paisa. It is how much actually? 1 rupee 50 paisa. 1 rupee 50 paisa. Now what you have to do is earning per share. Earning per share is rupees 2 rupees 50 paisa. Now dividend payout ratio is equal to here it is there, dividend per share divided by earnings per share. Dividend per share is how much actually? 1 rupee 50 paisa divided by earning per share is 2 rupee 50 paisa. So 1 rupee 50 paisa divided by 2 rupees 50 paisa, it is 0.60. 0.60. This is dividend payout ratio. Dividend payout ratio is 0.60. This is how we have to work out this problem. In this only the last one, dividend payout ratio, you practice minimum 2-3 times, then it becomes damn easy, right?